Hello everyone, I'm Nova Lui, Head of Investor Advisory at RHB Bank. Welcome to our monthly Market Insight podcast, where we review the recent key market developments and how they are shaping investment decisions in the new year. December was less about short-term volatility and more about structural change, as trends in geopolitical, commodities, technology, and monetary policy reach important inflection points. These shifts are reshaping how investors approach diversification, risk, and long-term allocation. US Federal Reserve cut rates by 25 basis points but signal a likely pause, citing moderating growth, softer jobs, and still elevated inflation. Policymaker projection points to potentially only one cut in 2026. Treasury yield fell, US dollar eased, and equity closed higher. Borrowing costs may stabilize for now, however, savers could see lower deposit rates. Investors were caught off guard by a sharp escalation in geopolitical risk, forcing market to reprice uncertainty across commodities and currencies. South America and Middle East tension, alongside talk of tougher US measure on Iranian-linked trade, lifted Brent crude towards US $65, reviving inflation concern for energy importing Asian economies. Combined with ongoing tariff risks, investors fear a shift from rule-based global trade towards a more fragmented and unpredicted order, triggering flight to safety positioning and disrupting traditional assets correlation. US revived the talk of wanting Greenland, sending special envoy to handle the issue. US said Greenland matters for US security because Russia and China are more active in Arctics. Denmark and Greenland quickly rejected the idea. Separately, the US pauses leases for 5 offshore wind projects, including 2 linked to Denmark, hurting clean energy sentiment. Overall, this adds political uncertainty that can raise market volatility. Against this backdrop, gold's role has evolved well beyond that of a conventional inflation hedge. By the end of December, gold price were around US 4,300 per ounce, after briefly reaching higher level earlier in the month. This rally was supported by 3 key factors: a weaker US dollar, persistent geopolitical uncertainty, and sustained central bank buying from emerging economies diversifying reserve away from the dollar. December also marked a notable moment for Bitcoin. The digital asset stabilized its declining trend before climbing back up in January. While volatility remains, it is increasingly being treated as a non-correlated diversification asset rather than a purely speculative trade. In Asia, investor focus rotates back towards growth, particularly in Asia semiconductor sector, where momentum remains firmly tied to the global AI build-out. In Taiwan and South Korea, equity performance has been dominated by surging demand for high bandwidth memory and advanced logic chips, now critical bottleneck in AI infrastructure. Samsung Electronics and SK Hynix confirmed severe supply constraint, with projected price increase of up to 70% of high-end DRAM. This announcement pushed the Korea and Taiwan equity market to record high, reinforced Asia's position as the backbone of global AI value chain. China's manufacturing PMI slipped to 49.9 in November, signaling a return to contraction as production stopped and domestic new orders softened. Export orders improved after an October US-China trade truce, but competition pressured pricing and firms cut jobs and purchasing. Investors may watch for potential stronger policy support at upcoming economic meeting into early 2026. Alibaba share rose after results show AI demand boosting cloud revenue by 34% on year-to-year basis. Overall, revenue increased 5%, with China e-commerce revenue up around 16%. Broader China equity market sentiment was steadier. The Hang Seng China Enterprise Index up by 0.87% on the day of this announcement. China tech story started 2026 strong as AI chip maker Shanghai Byron Hong Kong IPO sparked fresh risk appetite. Share jumped about 120% intraday after raising Hong Kong 5.58 billion, with the retail tranche reported over 2,300 times oversubscribed. The move extends an AI rally since DeepSeek 2025 breakout and tighter US control on Nvidia chip, boosting demand for domestic alternative. More AI-linked listings are due to be listed in China in 2026. India Sensex and Nifty ended higher after RBI cuts its key policy rate by 25 basis points, extending easing to 125 basis points since February 2025, and keeping the door open for more cuts. Financials did gains, with autos and real estate also firmer as cheaper borrowing support credit demand. The Bank of Japan raised its overnight policy rate to 0.75%, the highest level since 1995, formally ending decades of ultra-loose monetary policy. Japan now stands out as the only major economy still moving decisively towards tightening. The implications extend well beyond Japan's border. For years, Japanese investors borrowed cheaply at home and invested overseas, particularly in US treasuries and global bonds. With domestic yield now more attractive, capital repatriation is becoming increasingly likely, placing pressure on global bond yield and renewing strains on the US dollar. Ringgit has shown strength against the regional currencies, supported by sustained foreign inflow into bond and confidence into ongoing fiscal consolidation. In his New Year message, the Prime Minister placed clear emphasis on execution discipline and institutional reform, reinforcing Malaysia's positioning as a neutral but strategic middle power amid global trade fragmentation. This stance has helped insulate key sectors, particularly in technology, energy, and data center investment, from the worst of global volatility. Looking ahead, investor focus is shifting from policy direction to policy impact. With Bank Negara Malaysia holding overnight policy rate steady at 2.75%, the key question for 2026 is not intent, but delivery. Specifically, whether structural reform can translate into sustained earning growth in a slower global trade environment. As 2025 draws to a close, the investment landscape reflects a world in transition. Policy paths are diverging, geopolitical risks are escalating, and diversification has moved from preference to a necessity. Investors are reminded to remain focused on resilience, balance, and disciplined allocation, positioning portfolio to navigate uncertainty while remaining aligned with long-term structural opportunities. Please speak with your RHB Bank Premier Relationship Manager to review your portfolio at your convenience. Until then, stay informed and stay invested. We look forward to connecting again in our next podcast series.